Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Friday, October 14th, 2022. Hope you're all having a great week. Excuse me. It's been a wild ride this week on Wall Street, which is, seems part of the course for what we've been dealing with recently. A lot of volatility, a lot of news to react to. We had just a tremendous historic reversal day yesterday, and then the market is giving it back today. So let's break down the action. Let's talk about what it all means. We'll start with the major catalyst of the week was that CPI reading coming out Wednesday morning, 8:30 in the morning, and it came in higher yet again, up 0.4% month over month. Many economists were looking to see a slight increase because a lot of the lagging data here is still covering months from the summer. So we did think that there would be a slight uptick, but this just reinforced the narrative that the market is fearful of, is that the Fed is just going to keep hiking rates. The more they see high inflationary data, the more they're going to keep hiking rates. Now, our position has not changed. Our position is that the Fed needs to pause here to allow the lag in monetary policy to take effect, right? The things that they are doing and have done don't instantaneously work in the real economy, right? They take time, and that's why it's like the bullwhip effect, right? It's that monetary lag, or I should say monetary policy works with a lag. It's always been that way. So this recent movement in rates, which has moved all types of short-term financing instruments, particularly on the longer side, mortgage rates, we've seen big climb in mortgage rates. The impact on the housing market has not yet shown up, right? For those of you watching this in New York, you know that if you were closing on a house today, you likely signed that deal 90 or 120 days ago, okay? So a lot of the deals that are still closing, right? So the Fed would point to the real estate market and say, everything looks fine to us. We can keep raising rates. Well, let's see where that deal flow goes over the next couple months. But again, we'll just reiterate our position. We think the Fed is using lagging data to make futuristic decisions, and that's not going to end well. But when I say that's not going to end well, I don't want to give you guys grave concern that this is the end of days here. It'll eventually cause certain parts of the financial markets to malfunction, not specifically stocks, more so credit markets, bond markets, and as we're seeing spilling over from the UK, pension markets. So that's something that remains to be seen. So let's take a look at the market. For a lot of movement this week, right after all was said and done, really more was said than done. Now, the market has really gone nowhere this week, but it has felt like anything but that, right? We saw, this massive gap down yesterday, right? So this is where we closed on Wednesday, right? And then, Tuesday. And then we come in yesterday. Actually, no, let me take one step back. They pushed the CPI. CPI is usually on Wednesdays, but they pushed it to Thursday. So we close Wednesday at this level here. And then we get the gap down on bad CPI data yesterday, Thursday morning. And then a ferocious rally ensues, right? So we saw something that we only see really once in a decade yesterday, where markets were at their 52-week lows, opened down by 2%, and then rallied 5% intraday, right? And, that is what a sign of capitulation looks like. That is a characteristic of a bottom, but we need some momentum, right? We need some follow through. And unfortunately, we got a great reversal yesterday, and the market tried to open higher today and was met with sellers, right? So this was the price action today. Markets open higher, and there's just really no buying conviction, folks. Nobody wants to be long the weekend, right? In terms of short-term traders, long-term investors, of course, are holding over the weekend. But so you just have sellers, more sellers than buyers. Markets gave up their gains there. So when we look at the 5-day chart, basically we retraced and gave some of it back. And we are slightly above where we closed Wednesday, as if Thursday didn't even happen. Kind of a bizarre scenario, but this is the market of anomalies. Everything seems to be an anomaly this year, so why not throw one more in the mix? In the macro view, nothing has changed, right? Markets are still kind of clinging on to that low there. We had a little puncture low yesterday, but markets are still holding on to those key levels. Now, again, we talked about 3,400. Yesterday's little wick down here was about 3,490. So we made our way into the 3,400s, and we did see some buyers emerge. So we still believe those levels will be very key to watch. Now, the game plan hasn't shifted, hasn't changed, right? This is our map moving forward, but we have some additional possibilities emerging now, right? So we talked about the inevitability of markets wanting to test in that 3,400 range. Maybe that's still in the cards, but potentially yesterday's gap down, which got us to about 34.90, could have possibly satisfied this price objective. Now, so again, there's two potential scenarios here. Either the market has already sufficed in reaching this level here, and now we're going to start a counter trend bounce out of this channel and towards 4,000 on the S&P, which I think many investors would be happy about. Or this drop yesterday didn't really go as far enough as we needed, and we go a little bit lower to retest this area, and then we make that move and start to make that trek towards 4,000 on the S&P. So we believe there's a bounce coming in this market, a more sustainable type of bounce, not just these multiple day bounces, but maybe something that lasts a couple weeks and takes us back to some levels we previously saw in July. So it's kind of wait and see here with the markets, right? Was this move down yesterday sufficient? Now we can start this rally, or does this market need to go a little bit lower, actually get down into the mid 3,400? So that remains to be seen. It's not all bad news in this market, though, folks. There's something to be noted about the internal strength of this market. So up top, you have the S&P 500 price action, right? And obviously, markets are making new lows. But down here, what we're charting is the number of stocks, individual stocks, that are making new lows, right? So you would assume, or you would draw the conclusion that as stocks make new lows, right, that more individual stocks would make new lows. But that's not what's happening here. Okay, we saw about 200 stocks make new lows in June when the S&P made its initial low. And now when we look at the data here, we have about 73 stocks making new lows as the market moves on to lower lows than June. So what that tells us is that a lot of individual stocks have started to move up off the bottom, have started to carve out their 52-week lows, and a continued improvement of these numbers would be a good thing. Now, one thing I just want to go back and touch on, because I wanted to mention it. A few folks reached out to us and asked about it, so it's very important. So we get a bad CPI number yesterday. How could the market rally on a bad number? Well, there's a couple reasons for that. Number one is that many investors were betting on the fall of the market. So everybody was one-sided going into Thursday's data, right? Everybody was essentially short in the short-term retail trading community. So crowded trades tend to lead markets to move the other way. But another thing we talk about a lot is you will know the market is starting to bottom or trying to go through a bottoming process when it starts to rise on bad news. Now, high inflationary readout yesterday was certainly not a good thing. But if you look through the actual components of the CPI, most components are trending down. The only component that has been sticky and elevated is what we would call shelter, right? Rent and housing. And as we just talked about, the effects on rent and housing from interest rate increases take a couple months to show up in those statistics. So as investors, I think, digested the number yesterday, yes, month over month CPI went higher, but the only component keeping that up high was actually shelter. And not that we're suggesting shelter is going to fall off a cliff, but there will certainly be an impact on prices in the shelter markets, in the housing markets, as interest rates increase as they have. So that remains to be seen where we go. And the last thing we wanted to share was yesterday's big reversal a clue for anything substantial? So basically, when you look at the setup, right, we were coming off of the lows, right? We were 52-week lows, and the S&P made a move, gap down 2%, then had a 5% intraday reversal. So if you look on this chart here, the signal dates are these little green diamonds, and it doesn't happen very often, folks. 1, 2, 3, 4, 5 times. Okay, looking back over the last 20 years, it's happened. And if we look at the previous 4 times it's happened, this lined up with a market bottom pretty well. Okay, so history doesn't have to repeat itself, but it can rhyme. And certainly, when we see this type of accuracy with this type of indicator, it's something that at least gets our attention, and we want to take pause. So we continue to believe that the market is due for a bounce here, whether it's bear market rally and we continue lower, or it's something that has some sustainability to it. We shall see. But a lot occurred this week. A lot occurred and nothing occurred all at the same time, right? So as of the trade right now, the market is actually fighting for a positive week, a negative day, but looking for a positive week here. We will see if we get it. If you have any questions, reach out to us. Always here to talk to you about anything that's on your mind. These are tough times for investors, but tough times don't last. Tough people do. We will get through this correction. We will get through this bear market. And when and how this ends is the uncertain part, But what comes next is not the uncertain part, folks. We know what follows every bear market is a new bull market, and maybe the bottom will only be a day, but the bull market that comes next will last for years. And we will certainly maximize that opportunity when we get to the other side. Have a great weekend, and we'll see you back for the next Heritage Market Update.